Oh, let's talk more broadly now. Despite the rocky moves on Wall Street today, the major averages are on track for their 7th straight weekly gain. Joining us now, Drew Pettit, Citi U.S. equity strategist. And Drew, I want to talk to you a little bit about your outlook for next year. But first, I got to ask you about this past few days of hearing from Jay Powell and then Fed speaking, kind of how the market is reading it. How are you reading it?
Look, I think this is supportive of equity markets and honestly supportive of our constructive outlook for the S&P 500. Just where we get a little bit concerned is you're probably pulling forward a lot of good news at this point. So look, at the end of the day, we think it's constructive. We think equity markets move higher from here, but we're pricing in some good news. So we'd rather buy pullbacks rather than chase rallies.
And Drew, when you say constructive, so the SPX, the S&P 500, a year from now, Drew, where do you think we are, and how dependent is that call on the Fed cutting rates next year?
Yeah, so look, we're looking for 5,100 on S&P by December of next year. So we kind of phrase this interestingly. Yes, the Fed is supportive. Yes, it should help us hold the multiple at about 21 times, but it only influences, it doesn't determine our call. So yes, lower rates, that's going to help the cross-asset valuation picture, which has really, really improved as of late. But at the end of the day, we think earnings growth in fundamentals is what's going to drive this market higher. At the end of the day, we think the multiple stays where it is, and we have 10% earnings growth, which drives upside from here.
And Drew, talk to me about the relationship between earnings growth, economic growth, and then also throw in the outlook for rates on there.
Yeah, so it's a little complicated. That's how we kind of spun this in our outlook. So yes, the economy does help earnings. We can't deny that, but it doesn't determine it either. So the S&P isn't the economy, and we kind of fight this battle internally and with a lot of macro-focused investors all the time. But we're getting a lot of productivity gains, which helps push earnings higher, even if we have a macro slowdown. This is definitely something that is more concentrated in the S&P compared to what we've seen in more cyclical sectors, or even when we move down into small cap. So at the end of the day, yeah, we could have slowing, but we're going to get efficiency gains. That's what's going to help drive earnings. That's what's going to help drive the market.
And Drew, this is your call coming here, as we've already seen, obviously, a nice rally in the market. So I'm interested to get your take on valuation as well. You obviously must think it's constructive still?
Yeah, so look, I hate when people start talking about the S&P in historical context. Yeah, look, I'm a student of history, but we can't just say we're going to trade at a 16 times multiple, because that's what the S&P's been average since 1940. Okay, great. Well, the S&P isn't the same as it was in 1940. We have much higher growth companies. They have better margins. They have better secular tailwinds. When you put that all together, and you think about where we are with interest rates, their decline of late, where we've come from a high point in inflation to where we are today, in our still resilient earnings outlook, honestly, 21 times is not unreasonable for this market. We think that's fair value. Where the Fed comes into play, if we get more than 75 to 100 basis points of cuts, say we do get 150 basis points of cuts like the market's pricing in for the Fed next year, it's actually possible you could see 23, 24 times on the index.
Interesting. Why would that be then? I mean, because if they're cutting more because, say, unemployment is going up,
here's where it gets a little bit messy with the macro.
Yeah.
If they're cutting to try to normalize because inflation's come down, but earnings growth is still constructive for the largest cap companies in the US, you can possibly re-rate them without having to collapse earnings growth. To your point, and this is what's honestly likely more plausible, if we get 150 basis points of cuts, there is going to be macro weakness. You're probably going to bring in earnings forecasts in that scenario. But what's constructive for investors, if we get more severe cuts in interest rates, it will help support the market even if earnings move lower. So that's why we think you can have a higher floor under the index in 2024.
And Drew, as if it wasn't complicated enough next year between the Fed, the economy, we also have to think about the election. That's another variable to consider. I'm interested just to, as a strategist, how do you think about that dynamic?
what keeps us up at night is fiscal impulse. So admittedly, rates coming down helps lower the interest burden that the U.S. is paying on its debt. But we are concerned that into 2025 and beyond, you might not see as many tailwinds from government spending. On top of that, we're talking about productivity in a really positive light when we talk about S&P 500 earnings. But the more productivity gains you have, it's at the expense of labor. So as labor kind of loses to capital and potentially even more the year ahead, then you start bringing up, I'm going to say, just you're going to put a big target on the back of big corporations. Labor's not winning, but you're winning more. All of a sudden, I think the election rhetoric from both sides might not be as positive in that situation once we get closer to the presidential elections.
Very interesting, Drew. So it sounds like, and I like this in your note as well, you acknowledge there are a lot of variables, and what the past year has taught us is it's tough to do what you do and forecast what happens in the market. So how do you sort of hedge, right? Hedge your view. I noticed that you say on dips you would get a little bit, take the opportunity to increase your defensive positioning. Talk us through that a little bit.
So actually, yeah, we would add select defensives on pullbacks, but what we're really suggesting to clients is don't go sell your growth winners right now. A really good time to realign your portfolios is on pullbacks. When we get those pullbacks, you could see the Magnificent Seven, a lot of the growth indices and growth stocks and sectors probably outperforming because they're not as directly macro connected. When you have that outperformance is when we want to rotate to cyclicals. Don't buy cyclicals on the rallies. Don't buy small caps on the rallies like we've seen in the past few days. Wait for a pullback, wait for a pause in the market, and use that as a better entry point. I think the action today really speaks to that because you're seeing small cap underperform, you're seeing some cyclicals lag. This is a better time to rotate portfolios than when you have these big 2-3% moves.